Welcome to this edition of the Maclendon Minute. In this video, we will take a look at emerging markets. We will define what an emerging market is and some of the countries that make up this category, some of the risks involved in investing in emerging markets, and why this asset class can be beneficial in a portfolio. An emerging market is a nation's economy that is in the process of rapid growth, industrialization. These countries possess securities markets that are progressing towards but have not yet reached the standards of developed nations. When you hear the term emerging markets, you may think Brazil, Russia, India, and China. These were the most talked about emerging markets countries, so much so that in 2003, Jim O'Neill of Goldman Sachs coined the acronym BRIC to identify them. In 2005, he identified 11 more countries to the emerging markets roster for their potential to experience broad-based growth over the coming years. These countries are nicknamed the N11. Bangladesh, Egypt, Indonesia, Iran, South Korea, Mexico, Nigeria, Pakistan, the Philippines, Turkey, and Vietnam comprise this N11. Many economists look at the macroeconomic stability, the political maturity, the openness of trade and investment policies, as well as the quality of education in identifying countries that would be considered an emerging market. Now that we understand some of the countries that make up emerging markets, let's take a look at how they operate. Emerging markets tend to react more quickly and sharply to macroeconomic events. For example, during the global financial crises of 2008-2009, emerging markets fell faster and harder than that of developed markets. But as the global economy began to pick back up, these countries recovered faster. Pro-growth policies by emerging market countries attracted investment capital, and then the rise in asset price attracted even more capital. This volatility, depending on your tolerance, can be well worth the risk. These markets have many risks involved despite the outsized returns compared to developed markets. Emerging markets can be prone to financial crises. Navigating government bureaucracies has proven to be difficult. Product quality can be unreliable, and sorting through investment opportunities or performance due diligence on potential partners can often be a guessing game. With that said, there are multiple reasons investors should be looking at emerging markets. Although they may be considered a more risky investment compared to other asset classes, within a portfolio, this asset class can help diversify your portfolio and actually help lower your risk. Investing in companies that have non-US earnings creates diversification in most investment portfolios, theoretically reducing risk. The population of nearly every developed country, with the significant exception of the United States, are expected to begin shrinking before mid-century. While some developing countries face similar futures, many have large, young populations that are increasingly moving to urban areas for employment opportunities. Emerging markets tend to have lower debt burdens than developed countries. Thanks to robust growth and spending restraint, many emerging market governments and corporations have healthy balance sheets. Citizens of emerging markets also tend to have higher savings rate, which bodes well for future spending should savings rates eventually fall to levels closer to their developed market counterparts. Productivity in emerging markets has greatly lagged that of mature economies. Analysts predict that better infrastructure and technological advances in emerging markets could greatly boost productivity, a major factor in sustainable economic growth. Ignoring this asset category can be detrimental to your asset allocation, as emerging markets will soon represent more than 50% of world GDP. Overall, if you focus on the news headlines and ignore emerging markets as an asset class when constructing your asset allocation, this could be detrimental to your performance and may actually increase the volatility of your portfolio. Should you like to discuss emerging markets or any other asset allocation topic, please feel free to contact us at 855-MAC-WEALTH. Thank you for joining us for this month's Maclendon Minute, and we'll see you soon.